as I said, the 50 line is an important line on the market, on the RSI. Above 50 suggests that the gains are greater than the losses, and below 50, the losses are greater than the gains. But with the 30 and the 70 line, it sort of depends on which market you're trading as to how to use these lines. As I've shown you here, there are different markets you can use the RSI for. In a trending market, you've obviously got uptrends and downtrends, so you look at the RSI in a different way. In a strongly trending strongly uptrending market, you'll see that just purely by definition, the RSI, or sorry, the price will be gaining across that period. So therefore, the RSI will be consistently pushing above 50, and furthermore, consistently more than likely pushing above 70. So you can get extended periods of time where the RSI is actually above 70, and therefore, just using 70 as an extreme scenario is not really going to work in a strongly trending market, because it can, as I said, spend consistent periods of time above 70 before retracing that move. So you generally, I would believe in that scenario, you'd be looking to use, I mean, I'm quite a cautious trader anyway, and I would generally look to use look for buy signals in an uptrend, and I'd look for sell signals in a downtrend. I don't like to trade against the trend, so therefore I'd be looking to trade into the corrections, and therefore the corrections you'd be looking at your signals, your buy signals, maybe between 40 and 50 on the RSI, and also then you'd be rising between 50 and 70 on the RSI. You're staying in that trade because it still shows upside potential, and then pushing above 70 again. Now you then start to think about, well, maybe if you're extremely you're seeing an extreme move above 70, how do I take how do I start looking for the profit trigger? Well, as I'll show you in a little bit, you can start to think about taking profits on a couple of signals, such as crossovers and divergences. But once again, I would not recommend being short on those signals. I just think that they would be more likely you'd more likely benefit from them being profit triggers rather than sell signals in a strong uptrend. Similarly, in a downtrend, you've got the opposite, basically, where the market is spending consistent times in decline. Therefore, the RSI is generally below 50. And looking to push into oversold territory, which is below 30. And again, it can stay below 30 for a considerable period of time. Once again, you're looking for your sell signals in a downtrend, because buying into a downtrend, I think, is a risky strategy. So you're looking for your sell signals maybe between 50 and 60 on the RSI, and once again, you are consistently in that trend. When the RSI is falling between 50 and 30, you've got further downside potential, so you stay in that trade, and then you start to think about your profit triggers when you move below 30. Sorry, your profit triggers on your short position on your moves below 30. So tips for, let me just show you thinking about it. Here we go. Why not show you the trend? Here we go. This is dollar yen over the course of 6-8 months between November 2012 and May 2013. So that's 6 months. And you see this consistent trending higher market, and look at the RSI consistently above 50. I've got a line in here at 48, but you can see that it's spent over a month above 70 here. So consistently above 70, you then start to look at your dips as your buys. So every time you dip, you come back towards that 50 point, or maybe even 40 here, you're still looking at buying. So here again, you're below around 50, you're buying. And then once you start to break down that trend, you get a gauge of how that is moving. I think when your RSI starts to fall below 40, you start to break that trend that you've been moving higher in. So you start to think, well, maybe this relationship is breaking down, and maybe it's no longer a useful strategy. So you then look at, oh, went one too soon. Tips for a ranging market. Okay, so this is the second type of market you can use your RSI in, which is a range-bound market, which is where the prices are generally moving sideways. And in a sideways trading market, you generally tend to find the RSI spending a lot of time just oscillating between 35 to 65. You might see a peak, you might see a little dip towards 30 or a peak towards 70, but generally these are seen as extreme moves, and you'd certainly be looking, I think, in a sideways trading market. This is the time at which I think is the easiest time to use the RSI in a sideways trading market, because you just basically look for your buy signals between around 30, maybe 35, and your sell signals up around 65 to 70. Nice and easy. So show that in practice. Again, dollar yen over the last 6 months, 8 months of this year, you've had a sideways trading market. Dollar yen's gone nowhere. And what can you see? You can see the RSI just moving nice and serenely between overbought and oversold. You could argue between 35 and 65. Every time you get towards maybe 35, 40, you're starting to think about your long positions. And then every time you get back towards 65 to 70, your short positions. Now, when does this relationship break down? I believe that now the move that we've seen in the last month or so, last 2 weeks, sorry, I think that means this breakout here where the RSI has gone extremely high, 78, I think it hit. Let me just see. Yeah, 78, which was the highest it's been for Lord knows how long. And I think that suggests now that the RSI is moving out of, the dollar yen is moving out of this sideways trending market, and it could now be looking to form a new trending market to the upside. I think the bulls are trying to gain control, and therefore, subsequently, I don't think you can now use this sideways trending market RSI strategy as something that you should be trading with. So that is the two different markets that you use the RSI on.